Hey everybody, Brett here. Welcome to my channel. Today I want to dive into the market. It's currently February 22nd. It's a Saturday night here in wonderful California. Thanks for clicking on this. If you like the video, feel free to like and subscribe. I'll be doing these updates on a regular basis. I want to dive into a few things in this video. I just want to dive into a little quick update on some of the policies that have been giving the market a little bit of turmoil, like the housing data that we recently got, the consumer confidence that's waning, as well as tariffs, and then of course we'll dive into the price action of the S&P 500 and we'll just kind of go over, the main purpose is to stay solvent, is to be ready and be adaptable as traders. I've been trading for 4 years and I love what I do, and I think this information is really important as we navigate 2020 2025. So let's get into it. I want to start with the housing data that we saw this past Friday, which was yesterday. Okay, so existing home sales was released yesterday at 7 a.m. The consensus was for 4.12 million home sales in the month of January. The previous month in December was 4.29 million sales in the month of December. What came in was unexpected somewhat. We got 4.08, which was actually below these expectations right here. So expectations were not in alignment, and we got a little bit of a surprise, and the surprise was of course lower home sales. If I click on and expand, it says existing home sales in the US sank by 4.9% to a seasonally adjusted annualized rate of 4.08 million. The sharpest decline in 7 months. This missed market expectations of 4.12 million. In the summary, mortgage rates have refused to budge for several months despite multiple rounds of short-term interest rate cuts by the Federal Reserve. Housing is just a challenge for a lot of Americans here, and just not good. And it's just not good. So the forecast for existing home sales, when we receive the next update in March, February is expected to be much better than home sales. So just keep that in mind. Moving on to the consumer here, this is an article by Steve Sosnick from Interactive Brokers. He published this just yesterday, and he's basically just relaying the information that consumers are just worried, their wallets are getting tight. Walmart recently released earnings saying that their guidance for 2026 is going to be not as good as it once was because of the tariff news and everything revolving around that. Steve Sosnick mentioned that he went to an investment conference this week, and he had some conversations with people who are feeling some of the malaise that is beginning to bubble under the real economy, but they remain optimistic that their investments will insulate them. So it's kind of a double-edged sword that's going on here. People still remain optimistic about AI, understandably so do I. However, the consumer is also struggling, kind of starting to go underwater a little bit here. Whether that belief is correct or not remains to be seen. Steve says, he mentions that many Walmart shoppers don't have the type of investments that can support that type of thinking. Most Americans live paycheck to paycheck. Their financial well-being is directly related to their employment and spending, not their portfolios. Thus, if the consumers are saying they are nervous in surveys and then demonstrating it via retail sales, we all need to be listening even if the broad market isn't. And also just a little bit of background, Walmart warns of slower sales gains after a bumper year. These are the key points to remember. Walmart's strong performance during the holiday quarter was driven by shoppers seeking deals amid high inflation. So Walmart's been very good in their strategy by being able to offer consumers the excellent price points. And despite meeting expectations, Walmart shares fell due to lower than anticipated revenue and profit targets for fiscal 2026, which means that they're expecting a little bit of a tougher year ahead. Walmart plans to mitigate the impact of tariffs by negotiating with suppliers and leveraging its scale to maintain low prices. Eggs, coffee, gas, right? I don't know if anybody's been shopping here in the US lately, but I know for myself, I have not been buying eggs. Eggs are like $8, like a dozen at my local grocery store, like at Stater Brothers. It's like absolutely ridiculous. Coffee and gas, some might consider those necessities. I don't really know, but overall, the prices that many Americans pay for everyday items, they've been stubbornly high, as the Wall Street Journal article mentions right here. The Walmart's chief financial officer mentioned that wallets are still stretched. So with the implementation of tariffs, if those increase costs, we have to be very careful. U.S. Walmart shoppers are acting basically the same as they have for several quarters, with cautious but steady spending. In Walmart's Mexico business, tariff talk has caused fear and some additional shopper pullback. Walmart has always had good negotiating power with suppliers to offer lower prices than its competitors. Right? The CEO says our prices are low and we are becoming more convenient. He mentioned that Walmart's strategy will be tested this year after the Trump administration imposed fresh tariffs on many goods that Walmart imports from China and has pledged to add tariffs that would boost costs on goods from elsewhere. So stay tuned. That being said, I really want to dive into the price action here on the S&P 500 because the market tells everything. No matter how many news articles we read, no matter how much fundamental analysis we perform, the price is always right for us as traders. This is the current price of the E-mini S&P 500 index futures, the current price that traders are willing to buy and sell the stock at. We are currently valuing the E-mini at 60.2975, and as we can see right here, there is a firm resistance at the 6163.75 level. No matter what opinions anybody has about the market, about AI being very bullish or about tariffs being very bearish, we cannot get past this area of supply. It's just 1, 2, and 3. 3 main points that we have come up and we have just gotten sent below. We also have this trend line right here that was just broken just yesterday with a big red candle with really good volume down here. So overall, we just need to remain solvent. We need to adapt and we just need to be ready because the market just might honestly go sideways for 2025 as the way it's looking. And if I add a study here, if I add the 50-day moving average, we can see that we're currently below the 50-day moving average on the E-mini S&P index futures. This tracks the S&P 500, and overall, that's just not the greatest sign. Volatility has been picking up. Current VIX levels are around 18.21. This is the market volatility index. Now for SPY here, we can clearly say that the trend is starting to reverse, right? We have a trend line 1, 2, and 3 that we touched on in the last video. I drew this here and I had mentioned that we do not want to see the S&P below the 50-day moving average, and that's finally happening, and it's just not really looking the best. It can be really good if you see opportunity. Remember, we're traders. We can trade the downside, right? We can easily look at this and just be like, okay, let's just reverse our positions, and this looks great. Let's make some money here, right? So that's what I'm really trying to focus on. We can see maybe some bounce here in this area. It is possible. I don't know how the market's going to open on Monday. By the close, I gave myself multiple scenarios. I was like, hey, we can gap down by a lot. The market can see a lot of uncertainty, and we can see something that happened back in August of last year where the market just continues to tank. That's surely a possibility, and I gave myself that scenario when I was managing my risk. Another possibility is that we continue to consolidate and we kind of just stay in this area, right? Another scenario is that we gap up, which I think is extremely unlikely. I think either we consolidate and just kind of hang out in this area, or we get a retest of this trend line, or we gap down even lower. Those are all probably the 3 most likely possibilities for Monday morning. The weekly candle just isn't pretty. It's just a nice solid red candle here. So current positions, currently I am bullish on QQQ and bearish on the S&P 500. I'm a little balanced currently. Honestly, it's still very, very mixed. We saw a big red day. The trend is reversing. That's evident right there. So I'll probably start reversing my positions to head toward bearish territory. Negative 10 delta on SPY, positive 10 delta on QQQ. The only reason why I still have bullish delta on QQQ here is because we are coming into the trend line on QQQ. We haven't broken this one, and we're coming into the 50 moving average right here on QQQ. So anything could still happen. We can still base out. We can still come up. But remember what I was saying in some of the other videos is that gap here on the SPY and how SPY likes to fill gaps, guys. This is just honestly just the brutal reality. We have this gap here at around 584 to 588, 589, and we can definitely come down and fill this gap and see even more decline. I do think that is surely possible, and the market's starting to head toward that direction. So be extremely solvent. I wouldn't, I'd be very careful if you're playing longs. So just remember that we have this gap here. Stay solvent, be ready to execute, and just ride the trend. In terms of any like death crosses or golden crosses, which are the 50 and the 200 moving average, I haven't gone extremely bearish yet because our moving averages, the 50 and the 200, are still above, right? We got a golden cross got a golden cross right there. back during the end of January. We're coming toward the end of February now, and just kind of waiting for another death cross to see if we get more bearish sentiment. What I mean by that is I want to see this average to 50, and I want to see it cross with the 200, kind of like that, right? Kind of like what we saw right here. I want to see that happen. That would indicate that the moving averages are all going in the same direction. Anything could happen quick. We can see big drawdowns extremely fast. Definitely a possibility. Market can do whatever it wants. Or we may consolidate and maybe come back up to retest this trend line up here, go sideways, and then kind of come back down a little bit as well. Those are always possibilities. So everyone, just a reminder, just to manage your risk, stay safe. I'm currently doing my best to manage my risk. I'm still positive for the year. And, you know, we still have the rest of the year to make really great, considerable money and see great opportunities. The market is an endless stream of opportunity. Honestly, none of this information should be threatening, no matter if we get downside or upside in the market. It's all opportunity, right? And especially if you're an option trader, you can profit from both the bears, the bulls, and being neutral, which is wonderful. Right now, I think it's starting to lean. We're starting to see signs that we're starting to lean more bearish. So with that being said, I'm wishing you the best in your trading endeavors in the week forward. And it doesn't look like the market's going to be taking any legs up relatively soon. So don't be surprised to see the market start to come down, maybe back towards those 590 areas on the S&P 500. Not a prediction. I just think it's very possible just from what we're seeing right now. So thanks for watching, everybody. I hope this was a nice, relaxed update in the meantime, and I'm wishing you the best in your trading endeavors. Get better this week, learn from your losses, and learn from your wins as well, and take care.